let's take a look here at the 60-minute chart of the S&P 500, with the gray area being the overnight trading and the white area being the trading that is during what we call the pit hours. So you could see Monday we were closed, of course, for Labor Day, but they did trade and got a little bit of a lift here over the overnight session, and then not much during that early session during the day. Tuesday came and market jitters came in as the trade war, or fear of the trade war, really picked up, and bonds fell pretty hard that day. And the market was down overnight. It tried to get a rally as Amazon rallied, and we hit that $1 trillion market cap in Amazon, and it churned back and forth. The market ended down for the day, but gave a good showing of it as it came back. Now, the market came back almost every single day after declining. You could see that each of these days was similar: decline and then rally back, and decline and then rally back, and Friday here trying to rally back here with a couple of hours to go. The Department of Justice came out with their investigation on social media right over here, if they stifle free exchange of views, and that testimony came. They sold them down early. The NASDAQ was down over 100, but then bounced back. Here on Thursday, China warned of retaliation if the president does impose those new tariffs, and the social media stocks fell very hard again, and NASDAQ was down at one point over 115, but then bounced back. Fed heads have been out these last few days of the week talking about higher interest rates, and they are facing the fact that growth numbers are starting to pick up and inflation is starting to pick up. Proof of that came actually on Friday. Trade tensions weighed on the markets early, but then we got a market that rallied back on some strong payroll numbers. But wages came out up 2.9% year over year. That's the strongest since 2009, and bonds fell 1 point on that news. Here, POTUS again came out on Friday with those threats, and the market, which was trying to rally, then settled back. You can see that channel that it's been trading down all week long since the market opened for real on Tuesday here, and we've been in this downward motion. So this has been a down week, as you can see, and the news certainly in the background bothering investors and giving them a good excuse to sell. Stock market S&P 500. So again, we had a couple different scenarios in here, which was RV cycle, the green one right over here, and the cycle that I thought was in play, which was the dark blue dashed one right over there with the half cycles visible. And we're both right at this point, because we said that both of those were turning down and the market was likely to move lower. Our target for the week was 28.73 to 28.60, and you could see the low here today for the week is 28.73. So I'm sorry, the low for the week is 28.64. So that is almost getting perfectly down to that zone. Now we're still in an area of risk. We had this note in here that risk increases, and you can see that. So we think it's going to be a down week again. We're looking at this 28.45 number as a likely downside target sometime over the next 3 to 5 sessions. So we think that rallies will continue to fail. We've had a number of them this week, and they have continued to fail, and we think that sellers have now come back into the market, and that this is just the beginning of the topping process. You could see our projections out here as we go further out into September, and that late September through November, December to us looks like much higher risks. In that period where I talked about significant corrections, I think are coming in there. And for those of you, again, that want to see our weekly analysis, you want to watch futures speak, and you'll be able to see that. Now, momentum's still strong in here. We talked about that last week, that it was likely to keep the market from going into a real strong downside. That's why we thought that support support would hold. We still think the support area is going to hold right now, and we still think the momentum is not breaking down. All of our other indicators that we look at, for those of you that are members, are option bias indicators sitting at P3, the highest rating, and our market conditions indicators all just giving a little bit of ground from the 90s down into the 80s, which is still extremely strong readings. That's out of 100. So those are shorter term internals. They're not breaking down yet. We still think that it's going to keep the market from collapsing for a while. And for just this week, we're going to look for a continued modest correction or small correction to the downside, with risks picking up later.
I'm going to the city and I'm going to do a steady show.